Hello, everyone, and welcome to another edition of Friar Financial's Financial Forum. Today on our show, we're going to be talking about the relief rally in a world on edge, the resilience beneath the chaos, and we're going to begin our three-part series on women and finances, talking about the gender wealth gap. So, without further ado, we will get into our first section of Markets in Motion. All right, so Jeffrey, this was one of those weeks where the markets, they didn't just move, they reacted, then they recalibrated, and then they reacted again. The Middle East conflict continues to dominate the global narrative, and this week brought a mix of cautious optimism and hard reality. So, on one hand, we learned that the US, Iran, and several regional mediators are actually discussing the framework for a potential 45-day ceasefire. Now, that headline alone was enough to give markets a little lift. So, anytime you hear ceasefire and negotiation, investors perk up a little bit. And it's a big but, the details actually tell a different story. So, the reports suggest the odds of a deal are still quite low, and Iran has already rejected reopening the Strait of Hormuz as part of any agreement. That's not going forward at all. That's the non-negotiable piece for the global economy. Without that, the conflict's impact on energy markets remains front and center. And then you have this pressure campaign. So as you know, today is the deadline for the reopening of the straits, I think at 8 p.m. or so.
Mhm.
And so Trump has repeatedly told Iran that strikes on energy and transport infrastructure are coming unless a deal is reached by his deadline. Meanwhile, the latest U.S. and Israeli strikes killed the head of the intelligence for Iran's Revolutionary Guard. So even as negotiations are happening, the conflict is still escalating. Now, here's the real interesting part. Despite all of that, ships are still moving, though. 16 vessels have crossed the Strait of Hormuz since Saturday, and tracking data shows two more Indian flagged LPG ships exiting the Gulf. So it's not the normal traffic that we have, but it's not a complete shutdown either. And that little nuance matters a lot for markets. So all of this created a backdrop where investors were trying to make sense of the war headlines, the inflation expectations, and the Fed commentary. And yet stocks still managed to put together a strong week.
Yeah, that's right. So, and the market's performance kind of really surprised people with this. So, despite the geopolitical noise, stocks rose sharply over the kind of short trading week. The S&P 500 climbed up 3.36%. Nasdaq jumped up 4.44%, and the Dow added another 2.96%. And then we had the international developed markets were up 2.59%, and that's a strong rebound, especially after 5 straight weeks of losses. And now the week didn't start that way. Stocks were under pressure early on. Investors were digesting comments from the Fed Chair Powell, who said long-term inflation expectations remain well anchored, even with the conflict's potential inflationary effects. Markets weren't buying quite at first. But then Tuesday is when the script flipped. Stocks closed out Q1 on a high note, and the S&P 500 had its best day since May of last year. The momentum carried into Wednesday, helped by comments from the White House that suggested a resolution might be closer than people think. And then stronger than expected retail sales report. And suddenly the mood shifted from cautious to optimistic. And then Thursday brought a dip, but markets rallied into the close, officially breaking that 5-week losing streak. And even though markets were closed on Friday, everyone was watching the March jobs report, and they did not disappoint. Employers added 178,000 jobs, far above expectations of 59,000. Unemployment ticked down to 4.3%, marking the strongest month in over a year. And that's the kind of data that gives markets some confidence, even in the middle of a global uncertainty. So the story of the week, that was still the geopolitical tension on one side, and then we had economic resilience on the other, and then markets trying to price both at the same time.
Yeah, so that's I guess that's why we call this section or segment Markets in Motion. Is right now we just have so much stuff going on to try and battle and weed through and figure out. And as we mentioned, this week we haven't had to rebalance any accounts. So we think we've got everybody in a pretty safe space to kind of weather the storm right now that we're dealing with. So that'll wrap up our session on markets in motion. And we will see you all on the other side when we start up with finance in focus. Okay, so we're back with finance in focus. So let's zoom out and talk about the kind of the broader financial landscape a little bit because there's a fascinating contrast happening right now. So when you look at the headlines, wars, inflation, the Fed pivots, AI reshaping entire industries, it feels like a wall of worry. But then you look at earnings and profit margin, and those two tailwinds just are not slowing down. That's the disconnect that's keeping this market afloat. Now, the conflict is having a ripple effect across industries. Private equity buyouts fell by more than a third in quarter one, partly because of the software shakeout, partly because of the Middle East risk. And we're seeing consolidation across the asset management space as firms try to manage rising costs and intensifying competition. In biotech, Neurocrine Biosciences is nearing a $2.5 billion acquisition of Soleno Therapeutics, the company behind a treatment for a rare genetic form of obesity. That's a big move in a sector that's been pretty quiet lately. And then there's the tech world, which never stays quiet for long, of course. OpenAI's leadership is reportedly split on whether to pursue an IPO this year. Sam Altman wants it in Q4, but the CFO, Sarah Fryer, says the company isn't ready. That tension tells you everything about the pace of AI innovation versus the pace of corporate governance and who's going to win out. Also, because of the war and the ripple effect of the gas prices, Amazon is adding a 3.5% fuel and logistics surcharge for third party sellers in the US and Canada, a sign that cost pressures are still very real. And Apple's App Store saw an 84% jump in new app submissions, driven by the vibe coding trend. A reminder that AI just isn't reshaping enterprise software, it's reshaping creativity as well. And then you have the Hollywood headline. Paramount is reportedly in talks to secure nearly $24 billion from Gulf funds to help finance a takeover of Warner Brothers Discovery. That's not just a media story, that's a geopolitical capital story.
Mhm. And then with all that happening, we got some things that we're watching this week on the economic front. So we got Tuesday, we're watching durable goods and the consumer credit. On Wednesday, we're watching the Fed March meeting minutes. On Thursday, we got Q4 GDP, the second revision with weekly jobless claims. And then lastly, we got the wholesale inventories on Thursday. And then Friday, we have the CPI, the factory orders, and the consumer sentiment. So still a loaded week. And then for earnings, it's light on that side, but a notable week with Delta Airlines reporting on Wednesday. So markets, that's kind of the theme that the week is clear. The theme of the week is pretty clear. Markets are navigating a world full of geopolitical tension and macro uncertainty, but the economic engine underneath is still showing resilience. And that's why staying disciplined, staying diversified, and staying focused on long-term goals matters more than ever.
Yep, absolutely. And as always, we'll keep our eye watching the data, the conflict developments, and the earnings picture so our clients don't have to. So that's kind of where we jump in and build that fence around these portfolios for you. So that will end up the finance and focus section, and we will be back and start the wealth wisdom workshop again, tackling this gender wealth gap. I'm so excited to talk about this. This is going to be fascinating. So see you guys in a minute
Mhm.
in the wealth wisdom workshop. All right, so welcome back to the Wealth Wisdom Workshop. Our three-part series on women and finances begins today. So today we're starting with a topic that doesn't get nearly enough attention: the gender wealth gap. We already know about the pay gap. We're going to talk about the wealth gap today. So most people have heard about the gender wage gap. It's been discussed for decades. If we go back to 2022, women earned about 82 cents for every dollar men earned. And over a 40-year career, that adds up to more than $450,000 in lost wages. Now, for Black and Hispanic women, that gap is even wider. But here's the part that often gets overlooked: the wage gap is only the beginning. The real story is the wealth gap. Wealth is what you own: your savings, investments, home equity, retirement accounts, minus what you owe. And wealth compounds, it grows, it builds over time. So when women start with less, earn less, save less, that gap widens dramatically. So, one major study found that women had just 55 cents in median wealth for every dollar held by men. That's not a small difference at all. That's a structural divide.
Yep. And then that kind of leads us into net worth and why that matters more than income. So when we talk about financial planning, net worth is one of the most important numbers in your entire financial life. And the data is clear. The median wealth of single women is significantly lower than that of single men. And so why is that the case? It's because for generations, women face property barriers to credit, property ownership, and fair employment. And even though they have made progress, the echoes of those barriers still show up in women's balance sheets today. Systematic factors still make it harder for women to accumulate wealth, and that's why planning truly matters.
Yeah. So, one here's another big area along with net worth is longevity in healthcare. So, women
Hmm.
live longer, statistically significantly longer, and that's a blessing. But it also means women need more money for retirement. I often say this to clients: a woman could be retired longer than she worked, and that's actually not an exaggeration. On top of that, women spend more on healthcare throughout their lives, and especially in retirement. So when we build a financial plan, we have to account for longer timelines, higher medical expenses, and the reality that women often face retirement alone due to widowhood or divorce. Then there's the caregiving part, the invisible wealth drain. So here's another factor that widens that wealth gap: caregiving. Women make up the majority of caregivers for children, aging parents, spouses, and loved ones with disabilities. And caregiving isn't just emotional labor, it's economic labor. It affects earnings, promotions, career progression, social security benefits, retirement savings. It's hard to earn money, save money, or plan for money when so much of your time is spent caring for others. And I've seen this firsthand. Stop contributing to their retirement plan so they can fund a 529 plan or buy their kids stuff, or simply because they feel guilty prioritizing themselves. No, you need to prioritize yourself. And I always tell them you can borrow for college, but you can't borrow for retirement. So caregiving must be part of the financial plan and not an afterthought.
Hmm. So let's kind of get in a little bit more about the retirement savings and investment markets. So the 30% gap research from the TIAA Institute found that women have 30% less retirement income than men. And why that is because of the wage gap. It's because of time out of the workforce or access to employer plans. And yes, women tend to invest less, often because they've been socialized to be cautious or because no one ever taught them how to invest confidently. But here's some good news. Women are increasingly taking more control over their finances. More women are managing their own money. And over the next decade, women are projected to inherit 30 trillion in assets. And that's a massive transfer of financial power, which is huge.
Absolutely. So the takeaway is, what can women do? The first step is simple but powerful. Work with a financial professional who understands the unique financial challenges that women face. Women are natural planners. They plan for families, careers, caregiving, education, and everything in between. But many women don't realize that retirement planning and net worth building are also things you can plan intentionally, strategically, and confidently. So a financial planner becomes your advocate, your guide, and your partner in building wealth on your terms. So I'll let Jeffrey close us out today.
Yeah. And so the gender wealth gap is real. I think that's the biggest takeaway, but it's not destiny. With awareness, intentional planning, and then the right guidance, women can build wealth, protect wealth, and pass wealth on to the next generation. And this is just part one of our series. So I know we got into a lot today, but stay tuned because next time we'll dig into is your time planning boldly for retirement as a Gen X Black woman. So we'll dive in specifically on the Black woman.
Absolutely. So thank you all again for joining us. That wraps up our financial forum for today. And again, part one of the series was done today. We got two more parts to go to share information on specifically women and finances. So take care and everyone have a great week.